Good morning, everybody. As Toby said, my name's Daniel Vanderzeel. I'm a Director of Managed Accounts at Colonial First State. So on behalf of Colonial, hope you enjoy the gold chocolates, but also very excited to be here for the next 40 minutes or so to host a session with both global and local experts to look at the viability of gold as an alternative within portfolios. So you'd have to be living under a rock at the moment to have missed the resurgence of gold in 2025. It's up over 50%, and Jason and I were just chatting that overnight it's tipped the $4,000 US per ounce mark for the first time. So we're getting together now to talk through what's driving that demand, who is buying gold, how's gold being used within portfolio construction, and in the modern age, what are all the new ways of accessing gold and including in your portfolios. So as I said, pleased to be joined today online by a couple of global experts. Firstly, I'd like to formally introduce Marissa Salim. She is the Senior Research Lead at the World Gold Council, based out of Singapore. And Marissa will kick things off shortly before our panel session, introducing you to the World Gold Council, who they are and what they do. We're also joined online by Robin Sui, APAC Gold Strategist from State Street. Robin will share insights from a recent paper he co-authored on this space. And last but not least, joining us here in person today on stage is Jason Petrus, Director of Resonant Asset Management. And Jason's going to spend some time sharing how Resonant are using gold within their portfolios. So thank you all for being here. To kick things off and get things started, I might hand over to Marissa.
Thank you very much, and it's great to be here. So I first kick off with an introduction video about the World Gold Council. So that will take us to the start. Just 1 second. Okay.
The gold market has been evolving for decades, and the World Gold Council has actually been at the forefront of that development.
There are always new ways to think about gold, and it's our responsibility to champion those.
By being involved in every aspect of the value chain, we are able to help drive industry progress from mine to market. Gold has a critical role to play in society.
We provide data, research, and tools to investors that help them understand gold.
There is no comparable resource out there.
We have been at the forefront of responsible gold mining.
We developed and issued the Responsible Gold Mining Principles, by which the entire gold industry should act.
Gold mines add value to communities.
There's infrastructure created from roads to schools, hospitals.
Supporting the vitality of these local communities.
The key aims of the Retail Gold Investment Principles are to bring trust and understanding to the market. We are working with dealers across the world so that they demonstrate that trust to the investor. We have developed mandatory hallmarking in India.
Hallmarking is a stamp of trust and transparency in the gold that people buy.
We have been instrumental in opening up new markets around the world.
We've worked with governments and regulators in the industry to support the development of transparent pricing information, where the gold comes from, and who is involved in that gold ecosystem.
It will help provide confidence for the investors to trade gold.
Gold 247 is our vision for transforming the gold market to meet the needs of today's consumers and investors.
We are going to see a universe where every gold bar is logged in a digital database.
Creating a digital twin of every single bar in a distributed ledger.
The benefit is to have one source and one form of gold tracked worldwide.
We are trying to make gold as usable and as friendly and as transparent to trade as any other asset class. The process of digitalization will allow that.
We lead the way in advancing the gold industry.
We are focused on only one thing. We are focused on gold. And so as a consequence, we are experts at it.
Right. Thank you for that. And I'd first start off with a short presentation. So I've got a couple of minutes, and I wanted to also share just really in depth about what we are. So as you've seen from the video, we are a non-profit membership organization for the gold industry. So we really champion the way the role gold plays as a strategic asset, especially throughout the supply chain. We want to work with, artisanal small-scale gold mining. We want to work with communities surrounding these mining towns, as well as, in the digitalization of gold. So it's really an end-to-end process, and we have people all over the world making sure that we are able to reach these goals. And these goals are really simple. We really want to improve the understanding, access, as well as trust in gold for the rest of the world. So my slides are really short, but I just wanted to share with you this image of the cube. So you can look at it as like the balance sheet for the gold market, and it really is comprised of jewelry and technology, which is about half of the cube, and it's in the hands of consumers. We also have retail bars and coins. These are kilo bars and coins as well. So this is about 21%. So even in the form of retail investors, a large chunk of gold demand sits with them, which is around 70+%. Now, investors hold about 8% of the cube, and then we also have central banks, which hold about 17 plus% of that. And central banks use gold as part of the official reserve assets. Now we're looking at both demand and supply. So first we'll start with demand. So for global gold market, demand is pretty much an Asia Pacific story. If you look at, the bottom right hand of the screen, the usual suspects are really Greater China as well as the Indian subcontinent. They really account for about 50% of global gold demand already, and 10% of it, is in the Middle East. But we know that, most of this Middle Eastern demand actually flows into India in one way or another. It's really there to support the Indian market. And then on a whole, the emerging market demand accounts for about 70%, and then for developed market, around 30% or so. So gold really, it has been an Asian story, and we're seeing that, in the numbers and the data that we track. Where we're looking at supply side is a little bit fragmented because we have gold mines in every corner of the world. We even have it, here in Australia. We have it mostly in Africa, as you can probably guess, North America as well as Central America. So the divide across the continents for global market for supply, it's quite fragmented, but quite balanced as well around the globe. And just as a perspective, right? When you're talking about open pit mines, having about 1 ton of ore, you crush that 1 ton of ore, you probably can be able to get about a half a gram to 3 grams of gold. So this is how much work it's needed just to get maybe a few grams of gold. That's for open pit mines, and then in some perspective for underground mines, you get better yield, but for 1 ton of ore, you get about 2.5 grams, about 5 grams of gold. So you really need to crush a lot of ores just to get a few grams of gold. Gold itself has a dual nature, and the reason I say this is because its appeal happens in both pro-cyclical, so the counter-cyclical markets. During expansionary markets, of course, people would have a lot more higher disposable income, so people do allocate more into jewelry as well as technology, and that supports around 40% of demand. When in times of uncertainty, like what we are seeing since some time last year up till today, a lot of it has been driven by the investment appetite, and the drivers are really the uncertainty, geopolitical persistent geopolitical risks, and we see this investment side of gold really shining through. Another key player for gold is actually the central banks. So central banks allocate to gold in both expansionary as well as uncertainty, more so since 2022, where they've allocated more than half of their decade annual average. So central banks are not as price sensitive. They really come from a multi-year buying program, and they really want to allocate into gold as part of an overall plan for the central bank itself. So as you know, as of yesterday, gold has topped the $4,000 USD ounce mark. And this chart I've prepared last week, so it's been a bit outdated. So as you know, if it's into the 40 plus or all-time highs this year, and it's really been driven by a lot of the geopolitical risk, uncertainty undercurrents, where investor inflows are going into the market. And when we're looking at Australia in general, this is not only the case for Australia. If you're looking at a lot of markets in general, when you're comparing gold returns in the local currency versus all other traditional major asset classes, you'll see that gold has been one of the best performing asset classes in local terms. So we're seeing that pick up globally and across all currencies. The thing about gold is that it also becomes more negatively correlated with stocks in extreme market sell-offs. So you probably read a lot of literature as well as some news where they are saying that October is a seasonal month for global stocks to kind of pare down a little bit, and some of these communications surrounding that have also turned and looked to gold. So looking at the data over the past decades from 1994, we've also run this simple analysis where we look at how the correlations between the ASX as well as Osborne versus gold and the ASX as well. So you can see here that in terms of correlations wise, gold has that edge when it comes to protecting portfolios during extreme market sell-offs. Now, the golden question really has been what has been driving gold demand over the past few months or so. So the reason for that, I can point it down to threefold, and this is really my final slide. So the first is the sharp inflows into the gold-backed exchange-traded funds. We are seeing that we're seeing a re-emergence of that. Really, it was negative. It was outflows for gold-backed ETFs in 2024. However, in 2025, they really started off with a bang. Most of these inflows are really coming from North America listings as well as from China. This current few months as well, we are seeing a bit of return for European investors going into gold-backed exchange traded funds. So this is something that you want to look at. This is also the marginal buyer. So this is probably the part of the market that's pushing the gold price performance up as well. Again, the main piece of the puzzle here that we've seen since maybe 2022 has been central bank demand. It's remained healthy, they've remained net buyers, and it's really driven by emerging markets such as Poland, Turkey, China, as well as India, etc. The next thing that we're looking at for the first half really is demand for gold bars and coins, specifically also driven by Asia Pacific investors. So retail bars and coins have been the strongest first half that we've seen since 2013. And demand from Asia Pacific is actually 60% of total global gold demand for gold bars and coins. So with that, I think I end my part of the session today. Thank you.
Thank you, Marissa, very much for setting the scene for us today and giving some insight into the gold market and some of the drivers of the growth through the last 12 months. We'll turn our attention now to the panel session, and let's focus on portfolio construction. So to kick things off, Robin, I'll have a question for yourself. Can you share some insights based on the research you've recently completed around how gold has traditionally been used by investors?
Yeah, thanks. So at State Street, we recently updated our paper for Australian investors So specifically, we're looking at how Australian investors using gold in Aussie can use that to construct the portfolios. What we found is quite similar to Marissa's slides. Gold in Aussie terms relative to other alternatives. So we compare to hedge funds, REITs, commodity, infrastructure, natural resources, and Bitcoin. It has the lowest correlations. So if you want to construct a portfolio, gold will provide the best diversification benefit. We'll also look at the beta as well. I think the beta is quite important because the volatility of those alternatives compared to your portfolios. Gold came out the best in terms it has a negative beta compared to other alternatives. So if you're looking at alternatives, I think gold historically has been the most useful in terms of providing the benefits. We also did a test around putting gold in a multi-asset portfolio. So including domestic equities, Australian 200, Australian bonds, a bit of alternatives. And we added gold into various portfolios ranging from 2 to 10%. And what we found, very similarly, the annualized return of that portfolio improves. It reduces the standard deviations. So that, in fact, improves the Sharpe ratio of the portfolio. So putting gold around 2 to 10% strategically, historically, it can provide that extra benefit to the portfolio. So I think for an investor, gold, even though it's performed quite well this year, the fact that it can provide that benefit on top of that performance, I think investors should look into gold as a way to diversify.
Thanks, Robin. And maybe just one more for you. Just looking at how investors use gold today, there's a lot of different ways they can access it. Are you seeing any trends in how gold is being allocated in portfolios today?
It's definitely, well, I cover APAC. So most of the APAC investors will prefer, maybe not Aussie investors, but outside of Aussie, Australia will be more physical. So the ETFs or managed funds, which tracks the physical gold prices. Outside of Australia, I think people has less knowledge of miners. So they don't have that expertise of researching miners. So the best way for them is to invest in a gold back ETF or managed funds, which tracks the gold price. And of course, in Australia, you guys have a bit more knowledge of researching miners. Australian, they have a preference for miners and ETFs and managed funds. So depending where the clients we are talking to, but what we found, what we will advocate to the client is that you got to have some exposure to physical back ETF or managed funds that tracks the gold price, because that tracks the gold price 1-to-1. Miners obviously doesn't track the gold price 1-to-1. That's something we have to advise the client if they want to get into those through those different vehicles.
And that might be a good segue to ask Jason a question. So Jason, as we said, you work for Resonant Asset Management, working for a lot of advisors around the country, managing portfolios through a managed account structure. How are you and the team thinking about gold as an asset class in your portfolios?
Thanks, Daniel. So yeah, I mean, there's a lot of things to take into account when we're doing portfolio construction. So just to touch on a couple of, I guess, the points that we were talking about in terms of the implementation. We do look at it on a number of different levels. So just see, yeah. So just quickly before we get into that, I guess just some of the supporting pieces around gold at the moment, and then I'll just get to that portfolio construction piece. But these are sort of the big four drivers that we see supporting gold at the moment. First one being reflation. So you've sort of got supply chain rewiring and government stimulus, all that are going to be pushing, basically on global inflation going forward. So we're not saying that's a hyperinflation sort of scenario. It's just that you've got continued inflation within the system, and people get concerned about that, and they naturally look towards gold as a protection mechanism within that. The other big piece then being a falling or a weaker US dollar, which I think has been a pretty big driver of it. So now underlying that, you've got ongoing deficits within most major westernised economies. You've got lower demand in trade settlements, and What that's talking about there is you've got the BRICS trying to move away from the US dollar standard on large sort of commodity contracts, and that's just outside of gold as well, but just, you know, it could be agriculture or whatever, but they're looking to move away from that US standard, so that's pressure there as well. And then you've got upwards of a $2 trillion trade imbalance in the US. Now that number's moving around a lot because of tariffs, but it's anywhere between $1 and $2 trillion. That money is basically moving away from the US and it needs to go somewhere, which then sort of brings us into the structural pieces that a lot of emerging markets and a lot of existing central banks, they don't need to hold as many US dollars as they used to. And one of the natural places they're going is actually into gold as a reserve base within their own balance sheet. So you've also then, we sort of talked about the mining got low supply as well. And then we all know about the sort of geopolitical unrest as well. So, so all of those things are pretty strong supporters of gold, sort of going forward. But I thought I'd also just do a counter argument that if there are any headwinds, look. Bottom line, it is very expensive at the moment, relative to all of the measures. So whether it's equities, other commodities, or sort of high value commodities like platinum, silver. Even if you look at it versus housing, maybe not Australian housing is probably the one exception there because nothing looks expensive relative to Australian housing. But if you look at US housing, etc., that's right up there as well. So. And then, you might get rotation into alternatives such as, copper hard assets, even into crypto. So there are some competing alternative elements in there. So, but back to your original question, just the way the slides were ordered. So, but in terms of accessing, I guess, and putting these into portfolios, particularly within managed accounts, the two that we can point to that we use in some existing portfolios now, ETFs such as NUG. So now there's a number of different ways to actually approach this, but NUG is one that is built on all Australian origin gold bullion. It's stored in the Perth Mint. And it's pretty straightforward one-to-one exposure to the gold price, give or take probably a little bit of noise. And we like that because it's quite pure in its implementation. We talked then about actual producers, so Newmont being one of the world's largest, I think if not the world's largest gold producer. That gives you a little bit more of a levered exposure, I guess, to the gold price because they've sort of more got of a fixed base cost of production. Gold goes up, so they're leveraged into that, the increasing price. And you can see that at the moment in the last sort of 12 months, gold's up around about 50%, Newmont's been up about 60%. So so you see you sort of do get those benefits in there, but you can get on the downside, obviously, a little bit more of a negative. Now, why we like doing that within portfolios as well is because Newmont actually pays a dividend. So one of the challenges that we always have is when you're building these portfolios, everybody wants a bit of yield, like we saw in some of those first couple of presentations, and if you're just holding these ETFs, they generally don't pay a dividend. With Newmont, they actually do pay distribution and pay a dividend. So that's sort of a best of both worlds when you're trying to have that defensive or alternative type of asset. So some others in there that I put in was just QAU, which is another ETF backed by bullion that's based in London. And then one of the more interesting ones that I was talking to Daniel about before was the PM Gold, which is the Perth Mint Gold. Now that's an ETP. ETP being exchange traded product. An ETP can actually, in the case of what Perth Mint have done with that, you can actually convert it into physical gold. There's a couple of steps you need to do, but you can actually take your ETP holding, you can convert it into a deposit at the Perth Mint, and then you can take that deposit at Perth Mint and actually turn up there and say, I'd like my bullion. So there's a lot of different ways you can actually approach this. So one of the things that I would say in terms of building a multi-asset portfolio that we always find, I guess, a little bit challenging, it's probably a question back to you, Daniel, as well. Gold is broadly under most platforms defined as an alternative. Now, for everybody that's up to speed with the way that alternatives are classified under a growth defensive categorisation, alternatives are categorised generally as growth. So when you're actually building a portfolio, you're taking this negatively correlated asset, which you could generally argue is a defensive play, and it's being classified as a growth asset. So that does sometimes make it challenging, and we've found that when we've had it in portfolios, especially lately, we're actually having to trim any gold positioning because it's getting bigger and bigger, and we're having to bring it down because it basically forces you over your limits on your growth allocation. So I'd say our largest client portfolio, customised portfolio, is running at around about sort of 10%, but we've had to keep trimming that back. So.
It is actually something that's come up recently, particularly on the first choice side, where it is allocated as a growth investment, and portfolios having to be tweaked a little bit from some groups building out tailored solutions on the platforms. I think that's similar with most others out there. Thanks, Jason. Robin, might swing back to yourself. Just in your white paper, there's some great insights about portfolio diversifiers. What are the risk and return characteristics of gold?
Yeah, I think one of the topics we look at is to look at the returns and risk characteristics of gold in USD and gold in Australian dollars, because you often find that not only investors in Australia but investors in Asia, they're not sure whether they should get exposure in USD or the local currency in the domestic country. But what we found is that what drives gold, it's the USD, because it's domiciled in USD. So the relationship between gold in USD and Aussie dollars is quite similar. So we look at the Sharpe ratio over the 1 year and 30-year term. It's extremely similar. So for example, over 30 years, the risk and return of Sharpe ratio of gold in USD is about 0.5. In Aussie dollars, 0.6. So across the 30-year, you get very similar characteristics. So when you think about investing in gold, you got to look at the US economy, obviously, but some fluctuation in the Aussie and US that could provide some gains and losses. But ultimately, what drives gold, what we found is the gold in USD. So that's why the panels mentioned about the US economy, the dollar, potentially the US shutdown, governments that we've seen in the last few weeks, that has compelled gold to now 4,000. So that's some of the drivers investors in Australia should look into. And as I said, gold provides an excellent hedge either way. So by using various vehicles that have been mentioned today, investors should have some strategic allocation in their portfolio.
And just on that, I was having a look on our platform before today around allocation to gold, and it looked to be around 3 or 4% allocation in a lot of the managed accounts that we run at CFS. I might throw it to all on the panel today. I know, Robin, you said sort of 2 to 10, but have you got views on how much should be allocated to gold within a diversified portfolio?
We do advise at least 5. But the clients we talk to, so it ranges from the asset owners down to the asset managers. On average, often we found a lot of investors still underinvest in gold. So on average, probably 1 to 2% at the moment. But I think what has happened this year is that the view we're getting is that investors globally, they want to increase their exposure. That's a reason why gold price is doing well. What I think most of the money that's gone into gold at the moment is more strategic money rather than tactical. So even through the ETFs, the retail demand, what we believe is most driven by the need to diversify. So I think there's more upside to gold, because if globally or in APAC, investors are only investing 2%, there's a lot more room to run or to grow in terms of reaching that 5 or even 10% in the future. So that's why we remain quite bullish in terms of the rising demand in Asia Pacific.
Thanks for that. Conscious we've got a few minutes left, so just a couple more questions before we go to the crowd here. Now, gold versus alternatives. And alternatives is definitely a buzzword I'm hearing in the industry at the moment. But so I wanted to ask a couple of questions around that. Maybe first for Marissa, though. Marissa, what are some of the trends you're seeing around gold becoming more accessible? You've talked around the evolution in this space, but could you give a couple of insights there?
Yeah, sure. So I think when it comes to accessibility, one part that you can think about it is the market penetration. So we have probably ETFs that are now available in different parts of, Southeast Asia that allows people to um, gain access to that quite easily. It also reflects the preference for that accessibility. For example, maybe a lot of people in Japan, they like getting access to their investments through digital means, and then an ETF on a platform is able to get them access to that. And of course, you've probably heard about the white paper that World Gold Council is putting up on the framework for digitalization of gold assets. So at first, while this is still, at its infancy, but the main aim is really to ensure that people can look at gold as a form of digital asset, so that and with moving into together with the times, right? It's really trying to see that, gold is not that thing that you put under your bed anymore, or it's something that is accessible within your phone. So, yeah, and in that regard, what we are putting forth, as well as, other things that you can probably see, like real world asset tokenization. There is also gold tokens out there that are contributing to this renaissance of getting gold accessible to digital investors as well.
Thank you. Second last question, I'll go to Jason. So gold versus alternatives. What trends are you seeing in this space, and the kind of conversations you're having with advisors that you work with? Is it a viable alternative to alternatives?
Yeah, absolutely it is. And one of the, I guess one of the key drivers within our space, within managed accounts, is the challenge that I think other alternatives that are coming in and offering themselves as a product is fees and is the performance to date. So it's always, I mean, this is all in retrospect, obviously, because we're sitting with gold up 50%, and then you've got a lot of hedge funds out there that would, if you want to look at say CTAs at the moment that have really been struggling, they've got an MER pushing 5%, and there's gold ETFs that will be 15 basis points, right? So it's, if you look at it on a retrospective basis right now, there's a lot of interest in it, a lot of supporters of why wouldn't you? It's performed. It's been zero negative correlation. So why do I need to pay all this money for these other alternatives? So it's a reasonable argument, but I think there's always a balance, right? You just got to find what the investor's actually looking for. But do we see it as an alternative? Yes. Would we like it to be probably more classified as a defensive alternative? Yes. But at the end of the day, it is an alternative by its very nature of the outcome.
Thank you for that. And finally, before I hand back to Toby for questions, a question for the three of you, and this is on record. Where do you think gold is heading, and what will the price be in 12 months' time? We'll start with Marissa, because I can see you on screen.
Well, at the World Gold Council, we don't really give forecasts for price. But again, based on what we are seeing in terms of the demand drivers, we do see structural demand coming in from central banks that may support gold price performance going forward, as well as the momentum from gold-backed ETFs that will also support gold price performance going forward as well. So yeah, so I'll leave the actual numbers to the other experts in the room as well.
Not even a range, Marissa, but that's okay. Thank you. I'll go to Robin.
I think we will see a 5, just a matter of time. So we actually had an ultra bull case of 3,900 this year, but that's been reached last week. We'll be revisiting our forecast in December, but I think definitely the base case for next year will be at least 4,000. We don't see any slowdown in terms of usage. In fact, we see growing usage despite the high gold price environment. So 4,000 to 5,000 range next year.
Sorry. And Jason?
Okay, so I'll say a 51% chance it'll be higher than it is now. Because we don't like to give out numbers like that. And you've got to attach it to a probability. But look, I mean, I think it's at the moment, it's trending very well. There's a lot of support, all those reasons. It's a hard thing to say, well, if you bought it 2 years ago, you're doing well. Would you buy it now? I think there's, you want to be a little bit cautious. Would you short it? I mean, I think you'd be very brave to be doing that. So, so I think the trends are good. It's got support, and I think the marginal, in any market when you've got marginal buyers across a lot of the spectrum, you're going to get those tailwinds. And I think central banks, non-US central banks, in a lot of ways, I think are probably the biggest lever there and sort of force on the marginal buyer. And they're pretty indiscriminate, right? They're not sitting there trading it; they're buying it every day. So it's just that constant, support for the price. And I think we'll just probably see it continue on in a pretty healthy trend.
Yep. Okay. So fives are in the picture. Well, Jason, thanks very much for joining today, and Marissa and Robin in particular for joining from Singapore. We all appreciate it. So thank you for your time, and we'll open up to questions.
Thanks very much, Daniel. So questions from the floor. So, yep.
Yeah, just wondering, do you feel like there is a discrepancy between valuations of gold miners and the spot price of gold at the moment? And is that something you consider when you're looking for further value when you're putting together your portfolios? So do you think, okay, if there is a discrepancy, is there more upside in high quality gold miners compared to where the spot price is?
Yeah, I think you need to be very careful about what gold miner you're using. I mean, we use obviously Newmont as the example there because they are actually, one of the largest, if not the largest, and they're producing, they're established. You don't really have a whole lot of, I guess, risk in terms of they're going to, lose on a implementation basis, right? So there was a big deal went through the other day on the gold, but there's M&A and activity in the space now. But what's really interesting about the M&A that's going through is a lot of those businesses are actually sort of marginal. Now they've got projects out there, but what's happened as the price has gone up, obviously people are now coming back in with capital expenditures, but you are chasing a decreasing pool of asset in the ground. So it is going to be interesting to see how well they can go. But I think there's definitely a point at which you tip from taking a punt on an individual company to actually be able to deliver on a program, as opposed to something like as an established Barrick or a Newmont that you're actually got a genuine correlation there to the gold price because you know that they're going to be able to deliver on the actual product. So I think you've got to, and there's a whole lot of stuff in between as well. So and then you've got diversified miners that have got a toe in the water, but it's not the whole show. So that's why we use Newmont, is because we know that it will deliver on its production schedules, generally speaking.
Other questions? Because I've got one for you, Daniel. I don't want to put you on the spot, but I know that when Stuart Elliott gets here to talk about alternatives, for example, which I think is the last session, one of the things which will come up in that session is digitalisation. And it's come up in this session as well, the digitalisation of gold. I mean, how well developed is CFS or the platforms generally, do you think, in accommodating, the digitalisation of this asset, other assets?
I think it's an area where we're continuing to work on and focus on. I think the alternatives and private space in particular at the moment is an interesting one. So we're looking at solutions in the managed account space there. There's continual demand, but I think obviously ASIC are coming out with some guidance in the next month or so as well. So I think still a bit tentative in the alternative space, specifically to digitalisation. Toby?
Other questions? Because I've got one about the sort of, given that US equity markets are so fully valued and gold's been a hedge against downturns in that market in particular, do any of the panel have a view that the thing that's sustaining this is the risk of US market correction?
Do you want me to go over that, Toby? So when you're using gold as a hedge, I don't think you can look at it on an individual day or even individual week. It's a longer term against certain economic type dysfunction with its ultimate, sort of Armageddon type, scenario. So, but ultimately I think it's an inflation and a reflation, type of, and probably a debasing of the US dollar, as opposed to just outright saying, well, I'm going to buy gold to hedge against the S&P, dropping 20 or 30%. That's not the mindset that I'd take. I think it's just a broader portfolio diversifier. And the reason I say that is because markets just becoming, especially in equities, becoming shorter and shorter focused. And we've seen it before where, even if we look back through COVID, in the initial stages of COVID, gold was actually down. So, and that wasn't anything to do with, the demand for gold. It was just simply people were liquidating everything. So, and they needed to raise the cash. So you just got to be careful about, looking at market shock in terms of an outright liquidity crunch as opposed to a structural hedge. You just got to understand what you're playing with.
I would love to get the panel's view on something. I've just did a quick Google search and looked at the S&P 500 5-year return, 93%. And I know that the view is gold as an alternative, diversified, negative correlation to markets, but the recent performance seems to be correlated with US equity returns at least. So particularly with Robin, with your analysis, like how back did you go in history? And because the recent performance seems to be highly correlated, I know historically that could be different, but if we're thinking about putting gold in portfolios and we've got strong tailwinds and we're trying to use as a diversifier, how does that play out?
Yeah, that's a good question. So we try to go back as far as we can using all the indices. So it's around 25 years. So you go back at the start of the decade, year 2000. But you're right about the correlations. I think what we've seen, I think most of the clients we're speaking to, they're still quite bullish on the equity market. So what we've found is that they're actually keeping their equity portion the same, but they're moving some of the bonds into gold. So typically, if we're talking to a client, they might have 60-40, but going forward, they might have 60-35-5. So that's the trend we've been getting, especially some of the asset owners. They're moving away from the US bonds or US Treasury into gold. So there was a question about the S&P going higher. If you look at the S&P ratio in gold terms, it's actually in line with the past 20 years average. So in terms of gold price and S&P, they're rising together. But I think if there's some sort of corrections, gold will benefit. We just don't know when, but a lot of clients in Asia Pacific, they're still quite bullish on the US equity. But as I think everyone mentioned here, we can't predict the future. So you got to have some gold just to diversify. Either way, the performance and the low correlation with global and the ASX 200 or 300.
I know we're out of time, but I'll just add to that quickly. I think you've actually got two different things happening. I mean, there's actually the overlap for S&P 500 and gold is probably more an inflationary argument. But within the S&P 500, you've had Mag 7, AI, tech just absolutely steamrolling, which is obviously not really related to gold in that respect. So now maybe you could just say that's a point in time where you've had this 5-year period where you've had a number of drivers work for both asset classes. So there is a bit of coincidence in there, but they've both been beneficiaries based of an inflationary environment, and that's given her that extra kicker as well. So I think you sort of got to look at a couple of different drivers there.
Yeah. One from me. So Jason touched on an interesting point. I mean, an asset normally has a capital element and an income element. But Jason touched on the logic around buying a miner partly for the dividend income. Is there a demand or is there a product available that does give some sort of income element to a gold exposure? Or is there demand for that, do you think? And it's probably one for the panel more broadly.
So at State Street, we had a few inquiries around investing in gold and having the options, like writing options to pay the interest. I think some of the cover calls ETFs, if you invest in equities, it's becoming quite popular globally. But we actually did look at this scenario, I think a few years ago, and we asked a lot of investors globally if we have this product, investing in gold but pays dividends, so we reduce the capital gain and pay cash. Would you be interested? And interestingly, a lot of people, they found that they're not interested because they have the capacity to generate that income themselves. What they want is a very simple way just to track the gold price through gold-backed ETFs or mutual funds. So a few years ago, there's less demand. Maybe we have to do another study, but people investing in gold, they know there's a reason why gold has no dividend, because there's no credit risk. So people do understand that if you invest in gold, you don't expect to get any income, but you get obviously that capital appreciation that we've seen in the past 5 years.
So one last point from me is Robin mentioned the white paper that State Street have produced. That is available, and we'll add that to the documents that you can download from the app. Look, please join with me in thanking Daniel, Jason, Robin, and Marissa.